Hey everybody, this is Alex Merced from Greico Financial Training, and welcome to an introduction to the industry. It's a fun way to start every Greico course, which is making sure that we're all on the same page as to what is the financial industry. So, before we get into all the fun bells and whistles, the financial industry is basically just the industry that helps finance things. What does it mean to finance something? It just means to find money you don't have. So, for example, one of my favorite analogies to appreciate what financing accomplishes is pizza. And as you'll realize as we go through the course, that everything relates to pizza. All of finance can be explained by pizza. What do I mean? Imagine that you have $10 in your pocket. You go to a pizza place. Now, the pizza pie that you want to buy is $20. You have a problem. You need to come up or finance the extra $10 in order to buy the pizza pie that you want. There are two ways you can do this. If you have a friend who's with you, you can go to your friend and say, would you want to split the pizza? You get half the pizza, I get half the pizza, you pay half, I pay half. So they pay $10 with your $10 to buy the pizza, and they get half. What you did is you raised the $10 by selling ownership in the pizza. You just did what's called equity financing. So when we talk about companies selling stocks to investors, that's essentially what that is. You're selling ownership in the company to raise money for the company. But sometimes you want the whole pizza pie. So what you do is you go to your friend and say, hey, can I borrow $10? Your friend lends you $10, you buy the pizza is entirely yours. But whether you enjoy the pizza, whether you eat the pizza, you drop the pizza, and if it goes bad, either way you owe your friend $10 because they lent it to you. This is called debt financing. You raise the money by borrowing it. At the end of the day, everybody who needs to finance, whether there be companies, governments, individuals, they all finance in two ways. By selling ownership, equity financing, aka stocks, or debt financing, they borrow the money, and later on we'll talk about bonds. So, with that introduction, let's talk a little bit about the industry and go at a bird's eye view. Okay, so welcome to an intro to the industry. So everything revolves around a magical day 21, which will all make sense real soon. But essentially in the industry we really have two parts to it. We have the primary market and the secondary market. Now, in the primary market, the easiest way to think of primary secondary is think of it like a sweater over there at Macy's. When you buy a sweater at Macy's, has anyone owned that sweater before? No. It's a fresh, brand new sweater, and everyone pays the same retail price. But later on, that sweater may end up at a Goodwill or a Salvation Army, and someone else may buy it a second time. That second time, when something gets sold for the second, third, fourth, fifth time, it's no longer sold at Macy's. That's a secondary market for clothing. So think of Macy's as the primary market for clothes. Goodwill, Salvation Army is a secondary market for clothes. So same idea here. So in the primary market, which is really why Wall Street exists, it's the primary purpose of everything we do, which is to help companies raise money. So that way they can create the smartphones that make our lives better, and create the other technologies and businesses and services and goods that make our lives great. But they got to raise money to do it. How do they do it? Well, like we mentioned before, they're going to finance that money by either equity or debt. But unlike the pizza, you're not going to do the pizza you did on a handshake. You just said, oh, I trust you. I'll lend you $10. Or let's split the pizza. You're not going to do $1 billion, $1 trillion on a handshake. So in that case, people want things that legally show that they own the company. That's called a stock. They want something that legally shows that they lent money to the company. That's called a bond. And both of these are considered a security. So we're going to create these securities. That's what Wall Street's here for. So we help that company. We say, hey, you want to raise money? We'll help you create securities, stocks, and bonds, and then sell them to the public. So that way you raise the money. So we sell the stocks, sell the bonds, and now the company has the money it needs. It's financed. Now, certain terms that you want to think of as primary market terms are the following. investment banking. Okay, so whenever we think, there's two types of banks. There's commercial banks. Those are the ones that do your checking and savings account. And then there's investment banks. These are the banks that deal in stocks and bonds. Particularly when we hear the term investment bank, these are banks that are going to specifically specialize in helping companies raise money. Now, oftentimes these investment banks, when they go to sell the stock and bonds to the public, they're going to work together in teams. So that way, if more people are selling it, the risk of not being able to sell it is less. So these teams, these groups of investment banks are called syndicates, who are going to go out there and sell it. Now, the whole process of the investment bank, because the investment bank is assuming the risk that they may not sell it, and what's possibly called a firm commitment. We'll talk about that later. But the bottom line is that they're assuming risk. And generally, when we have a third party who's assuming the risk, we refer to that as underwriting. Okay, like an insurance company underwrites your life insurance policy. They assume the risk of that contract being used. When you buy a car insurance policy, the car insurance company underwrites your car insurance policy. They're assuming the risk. So investment banks are assuming the risk on behalf of the issuers, the companies who need to raise money. So they're underwriting. The new issue marketplace. We like to say, hey, anytime there's a new security, it's a new issue. So the primary market is a marketplace for new issues. And we also call it the IPO marketplace. An IPO is an initial public offering. It's the first time that a company sells stock to the public. Now, what happens is that in the 1920s, there wasn't the internet. So it wasn't like you could just hop online, look at a company's financial records, and know it was a good idea to buy. The only way you got information typically was through your broker. So what happened is that a lot of times your broker would not necessarily tell you everything you need to know to make an informed decision. So in a law called the Securities Act of 1933, which passed after the stock market bubble in 1929, in the Act of 33 they said from now on the government does not want to get involved in saying this is a good investment or a bad investment, because you don't know. Sometimes what looks like a good investment turns out to be a horrible investment, and what looks to be a bad investment turns out to be the best investment you ever made. So in that case, we just want to make sure people have an informed decision. So before we can sell anything to the public, we want you to create like a brochure, a booklet that tells you everything you'd ever want to know about this new security being issued. This document is called a prospectus. So under the Act of 33, we have to make a prospectus. But before we can give that prospectus to investors and then sell them the stock or the bond, the government wants to look at that prospectus. Now, the part of the government that oversees the securities industry is called the SEC, the Securities Exchange Commission. So we're going to file that prospectus with the SEC, and they have, by law, an obligation to look at it for at least 20 days before they can give us any kind of answer. Now, if everything goes well, the earliest they can give us an answer is on day 21, and they can tell us the security is effective, which just means the registration has gone through, we've met the requirements that's supposed to be inside the prospectus, but it does not mean it's a good or a bad investment. It just means we're providing investors with enough information in the prospectus that we can go out and sell it. So we deliver prospectuses to the investors, we sell them the stock, we sell them the bond, and the minute that happens, those investors begin trading those securities among themselves. And this is known as a secondary market. So when I buy an IPO share, the money from the IPO goes to the company. That's the primary market. But then when I sell my share of that stock to somebody else, that money goes to me. That's the secondary market. But where do these shares trade? It's not like they just trade anywhere. So what we're going to do is we're going to take a look at the different places stocks can trade as they get bigger. Now, when you're a smaller company, you're not going to meet what's called the listing requirements of the larger exchanges. So all the big exchanges, NASDAQ, New York Stock Exchange, they have requirements. And the idea behind those requirements is to make sure that your company is big enough, heavily traded enough, that it's liquid. Because that's sort of the point of an exchange, to provide liquidity. So we want to make sure that any stock that's going to trade on the exchange is already liquid. So when I see something is like New York Stock Exchange stock or a NASDAQ stock, I know that it's liquid. Now, what does it mean to be liquid? It just means that I'm always able to buy and sell it. So if I buy a stock today, I can sell it tomorrow. There are stocks and bonds out there that are not liquid, which means if I buy them today, there's a chance I may not be able to sell it tomorrow because there's no one who's buying it out there. And those smaller securities, those less liquid securities, they cannot trade on exchanges generally. So in that case, the only place they can trade are on places like the Pink Sheets or the over-the-counter bulletin board, which are more like a Craigslist, where anybody can kind of post, anybody can sell, anybody can buy. So, some days you'll see there's a couch on Craigslist, other days there isn't. Same thing with Pink Sheets and bulletin board. Some days they're selling that stock, some days they aren't. So some days you might be able to buy your stock, some days you might not. But as a company gets bigger and has more shares out there, they have more people, individual shareholders, a bigger market cap, a more what's called a market maker. A market maker is a dealer in the stock. So imagine like a car dealership, how there's many different Ford dealerships that buy and sell Ford cars. There are dealerships in stock. They're called market makers. They're people who commit to buy and sell a particular stock, providing liquidity to that stock. Because kind of like you always know you can trade in your Ford car to the Ford dealership, you can always at least sell your stock to a market maker. So more market makers mean more liquidity. So if you meet all those different requirements, more market makers, higher market cap, more shareholders, then you can be traded on the big stock exchanges like NASDAQ. And NASDAQ has several different levels, like NASDAQ Capital Markets, NASDAQ Global if you get bigger. Okay, and then there's NASDAQ Global Select, which is the biggest rung of NASDAQ, which is kind of on par with the New York Stock Exchange. Now, what we're going to do is we're going to examine this whole primary market thing a little bit more in depth and the sort of the financing of a company by raising money for a company called Greico Air. Greico Air is an airline, and they want to raise $900 million so they can expand and become a more bigger carrier. Now, they're raising $900 million. And so what's going to happen is they're going to present their idea to the investment bank in their investment banking conference room. And if the investment bank likes the idea, they'll begin the process, which means they're going to have their team of analysts analyze the company and try to project what profits they think the company can make. Because they have investors on the other side who expect a certain level of return. So if we expect that the company's going to profit this much based on our projections, which is just an educated guess, and we say, okay, well, investors want this kind of return, what price and how many shares do we need to sell to raise the money the company needs? Okay, so that's what the job of all these sort of investment banking team valuations are doing. So based on this particular company, we come up with that we need to issue 45 million shares of stock. And it's going to be Series A voting stock. All that means is that when you issue stock, you can issue many different series, and they can be slightly different. So you can have Series A, Series B, Series C. It just means there's something different about these two different classes of stock. Now, in this case, based on the valuation of the company, we're going to have to sell these 45 million shares at $20. That when we sell a new security to the public, the price that we sell it at is called the POP, the public offering price. Okay. Now, what's going to happen is that this investment bank who's walking through us all of this at this point, they're referred to as our advisors. So there's going to be many investment banks within this whole process. The first one's called the advisor. They're the ones who are saying, okay, this is the kind of security you should issue. Here's how we think we should set up your company. Here's how we should file the paperwork. They're advising you in the process of creating the security. And they're going to get paid a fee, an advising fee, for doing that. Okay? So they're helping us through all the legal stuff. The advisor. But later on, we're going to have to hire an underwriter. This will be the person who's going to go out and sell. It's not necessarily always just one investment bank. It may be many investment banks. And if it's many investment banks, the underwriter is then referred to as the syndicate because there's many of them. So it could be the underwriting group, the syndicate, etc. And the idea behind the syndicate is just that if we bring more people to help sell it, the less risk we all have because we got many people helping out. But the syndicate could choose to just do it by themselves. But if there is a syndicate, we got to choose one investment bank to act as the lead underwriter, the book runner. So basically, at the end of the day, all the different orders taken by all these different investment banks in the syndicate, they're all kept track of by one lead underwriter, just one person who manages the book of orders. That's why they're called the book runner. So at the end of the day, when we need to actually distribute the stock or bonds, the syndicate manager can look at the book of orders and say, okay, these orders need to get filled first, these orders need to get filled second, etc. And that's what the manager of the book does. Okay? Now, the manager is basically, again, running the syndicate, managing the day-to-day, and they're the ones who are going to keep track of all that stuff. But in order to create a syndicate, there are many documents that are needed. Okay? The first one is the letter of intent. The letter of intent is just the investment bank saying, you know what, we'd like to be your underwriter, but we just want to make sure that we know what we're doing and we know what we're selling. So we want you to open up your records, your books to us so we can start analyzing the company. So the letter of intent, the issuer signs it, the investment bank signs it, and then the investment bank can begin doing their research to make sure they're assessing this product correctly. But the different members of the syndicate, they have to agree with each other, because you may have 10, 20, 30, 40 different investment banks in the syndicate, and they all have to agree on what percentage they're going to be expected to sell, how much money they're going to get paid for selling that amount, and all those details are outlined in the syndicate agreement, also known as the agreement among underwriters. Okay? So be careful. There's a syndicate agreement, aka agreement among underwriters. That's the agreement between the different members of the syndicate. But there's also a separate document called the underwriting agreement, which is the syndicate agreeing with the issuer and what the terms of the deal are. So just make sure you be very careful with the terminology. Now the different syndicate members, what's going to happen is whenever they sell a stock, so let's say we sell it for, again, we're selling it for $20 a share, we're going to take a little bit off the top. So we'll say we take $1. So for every $20 share we sell of Greico Air, $1 goes to the investment banks, goes to the underwriting group. That's called the spread. So that means we're taking $1 spread, so out of the $20 that we're selling the shares for, 19 of it goes to Greico Air. And that spread then gets split up in different ways. There's a management fee that goes to pay the manager, because the manager is doing extra work, so they get paid a piece of it called a management fee. There's an underwriting fee that goes to all the different members of the syndicate, especially when it's called that firm commitment. Again, firm commitment just means that if the investment banks don't sell it, they're stuck with all the shares. So they get compensated an extra fee for taking the risk. So the underwriting fee is just the payment for taking that risk. Then there's another fee called the concession. And the concession is what we pay them for the selling of the deal. So basically this helps compensate for the selling of the deal, which is generally going to be the biggest part. So in this case, generally around 60% of the gross spread. Okay? Now, one of the first things we have to do when we're advising the company about raising money is what their business structure should be. Should they be a limited partnership? Should they be a C Corp, an S Corp, a limited liability company? There's so many different options on how you can legally structure your company, and each of them have different trade-offs as far as tax rules and other obligations. But generally, most companies that are going to go public are going to become corporations, specifically C corporations, because you're allowed to have unlimited investors, which we're going to need because you're raising a lot of money. But also corporations, they separate the owners from the managers. Because if you're going to bring in thousands, if not hundreds of thousands of new owners to the company, because each shareholder is technically an owner, that's a lot of chefs in the kitchen. So we don't want everybody, picture if everyone who owns a share of Facebook could go call up Mark Zuckerberg and start opining on how Facebook should run. It'd be chaos. So Facebook shareholders, the owners of Facebook, are separate from the people who run Facebook. Okay, that's our two-tier structure. So you have the people who run the company, the CEO, the CFO, the board of directors. So the way it works is that the owners, tier 2, the shareholders of the company, they'll vote on the board of directors, and then the board of directors will then appoint the CEO, CFO, etc. And that way the people who make the day-to-day decisions, the CEO, CFO, are twice removed from the shareholders. So that way they can be focused on running the company and not bogged down by having thousands, if not hundreds of thousands of people bugging them about every minute thing. But the thing is that in order to set up a corporation, this just doesn't magically happen. There has to be legal paperwork, because another benefit of a corporation is that you have limited liability, which means when usually if you own a company like as a sole proprietorship, which means you just do business under your own name, you have unlimited liability. So if someone sues you, they can come after everything you personally own to get what's owed to them. That's a lot of risk, and that discourages a lot of people from doing business, especially really big, large-scale, capital-intensive businesses where you can have a lot of legal liability if something goes wrong. So we came up with corporations. Corporations said, okay, fine, if you want to invest in building this thing, investing in this new technology, if you buy a share of this corporation that's been sanctioned by the state, so it's the different states of the United States of America that recognize these corporations, that the only thing you have at risk is what you've put into the pie. So if I buy a $20 share of a company, I can only lose my $20. So if the company gets sued into oblivion, I lose my $20 that I paid for the share price, but they're not going to come after my car, my house, etc. So in order to get that benefit, that limited liability, you have to file what's called an Articles of Incorporation with the state. Typically, the Department of State will take it. We get to file this document. Now, how does this document look like? Well, we're not going to go through every little clause inside an Articles of Incorporation, because that could be a whole semester of law school. But there are some terms you need to be aware of. So when we create this Articles of Incorporation, we have to authorize a certain number of shares. How many? As many as we want. But you don't want to do too little, and you don't want to do too much. Because if you do too little, then you may not have enough shares to sell later to raise more money. Because all the authorized shares is the number of shares you could issue. That's not the number of shares you are issuing. But I don't want to do too many, because that scares away shareholders. Because shareholders are scared of what's called dilution. If I keep issuing more shares, that's going to shrink the percentage ownership of anyone who already owns shares. And basically, so they're owning less of the company, so I'm kind of inflating away their ownership. Investors are really scared of that. If you haven't seen the movie The Social Network, the one about Facebook, that was one of the big points in the movie when one of the founders of Facebook got diluted and pretty much lost most of his ownership in the company. So that's one of the issues here. We want to not authorize so many shares that shareholders get scared away of potential dilution, but we want to make sure we don't authorize so little that, well, we don't have shares that we can issue later. So we're going to authorize 180 million shares. Are we issuing 180 million shares? No. As we mentioned earlier, we only need to issue 45 million shares. So those are our issued shares. Okay, and again, if we issue 45 million shares at $20 a piece, we raise our $900 million. In the future, the company may need to buy those shares back. Why? To give it to their employees as part of their stock options, to push up the price of the stock. You could do any of these things. And so, but when the company buys back its own shares, they are no longer in circulation. The company cannot sell them back into the market. They don't get a dividend. They don't get the vote. So these shares are like they don't exist. These are referred to as Treasury Shares or Treasury stock. They're shares of the company bought back by the company. So Facebook, the company, buying back Facebook shares. Microsoft, the company, buying back Microsoft shares. Okay? Well, right now we just started this company, so we don't need to buy back any shares yet. So there's going to be 0 Treasury shares. So if I have 45 million shares and I've bought back 0 of them, so I must have 45 million outstanding shares. And those are the shares that do vote. Those are the shares that do get a dividend. So when people ask you what percentage of the company you own, it's not based on the authorized shares, the 180 million. It's based on the percentage you own of the 45 million outstanding shares. Because those are the shares that actually exist, that are out there, owned by people. Now you can remember the formula for outstanding by remembering issued minus treasury equals outstanding. I minus T equals O, which spells Ito. Everybody's favorite judge from the OJ trial, here to help us pass our exams and learn about the financial industry. Okay, so you can remember that, and I will see you guys on the next portion of this course.